Okay, so hello guys and welcome to my fifth time trying to record this video. So yes, the last four times were unsatisfactory. In a few other videos, I was probably 10 minutes into the video and I had to restart because I maybe blundered or something. Now, I don't like to edit my videos. I like to just make it raw and plain, and we're going to carry on with that theme going on into this year. So the main topic for today is my oil price predictions and what I think about the Iran civil unrest and all that is going on geopolitically, especially with the U.S. Arresting the sitting president of Venezuela, and how all of these geopolitical factors, how they all would affect oil prices. Now, the major question for me in terms of trying to go about my analysis. Now, typically what I would do first off is I would go on the charts and try to look at narratives on the charts and try and make a thesis as to what I think the market should do on a much more macro basis, and of course then go on the lower time frames and try to refine that, and then do some more into market analysis and try to blend all of that together. But I wanted to take a different approach today, and the reason why I wanted to take a different approach today is mainly due to the fact that we are not in just a normal market environment. Now, if we were in a normal market environment, I would go about my analysis as usual, but we're not. We are in a situation where there is civil unrest in Iran. And just so you guys have an understanding of the importance of Iran in terms of global oil supply. Now, Iran does not contribute as much as like Saudi Arabia. Saudi Arabia does, I think, about 18 to 20% of a global oil export, right? So that comes from Saudi Arabia. And I think Iran probably does around 2% to 2.2% ish, right? So it's not that significant in terms of global oil exports. But the one thing I want you to factor in is there is something called the Strait of Hormuz, right? Strait of Hormuz is a channel. It is a choke point that controls exports from the Middle East. That controls about 18 to 20% of global oil exports that comes from the Middle East, and Iran is a part of them. So, of course, a conflict in Iran can potentially trigger, or not trigger is the word, but it can potentially affect oil production around that Middle Eastern region, not necessarily Saudi Arabia or the UAE, because they have a lot more stable governments, right? Stable governments and much more stable policies revolving their oil exports. But we still have the fact that a civil unrest in Iran with probably intervention from the United States can affect the geopolitical environment around that region, right? So we're talking about Iraq, for example, right? Like a trickle down to Iraq, and that can potentially hamper global oil prices, right? So typically when we have a situation where there is a potential geopolitical uncertainty, where there is a threat of war, there is a threat of, for example, like we're seeing in Iran, the possibility of overthrowing the sitting government, and how messy that can get with maybe nations intervening, for example. Maybe the U.S. decides to intervene. If you look at the rhetoric with Trump, so I went on Twitter today and you could see the rhetoric with Trump was becoming more increasing in terms of, so just to, in my own words, just to summarize what Trump said, he was saying something more of the fact that he stands with the people of Iran and the U.S. is in standby, ready to help whenever. So you can see that kind of rhetoric is more indicative of potential U.S. involvement. So if there is going to be potential U.S. involvement, there might be other players like Russia, for example, or China, for example, because China gets a lot of your oil. They're one of the biggest importers of Middle Eastern oil, and also from Iran. So China potentially can get involved, right? So it can become a really messy situation. Now, typically when we have, let me explain commodities, right? So we have different asset classes. We have speculation asset classes, currencies, for example. Currencies are not assets in the way that commodities are assets, right? Because currencies are not fixed in supply. Assets like commodities are fixed in supply. That's why we have real supply and demand factors that does affect commodities, right? So there are multiple factors that would affect the real world supply and demand of a commodity. This might not necessarily be the case for speculative assets, right? That's what we'll call it, like, currencies, right? So when we talk about commodities like this, assets that are influenced by real world supply and demand, it is always important to understand that when we get into what I like to call special circumstances are situations in which geopolitically, physically, something major is going on physically that could hamper investor confidence, number one, right? Investor risk appetite, number two, and then real world supply and demand factors. So I just gave you 3 points, right? Number one is investor confidence. Number two is investor risk appetite. And then number 3 is global real world supply and demand factors. When we have these things that can affect actual commodities like this, it is important to factor in all of that. Now, I have a general rule of thumb, right? Whatever the news is, do the opposite of the news. That is my general rule of thumb. Now, one key information to absorb here is that institutions typically, they will position themselves ahead of the news, ahead of the news cycle. Institutions usually tend to position themselves way ahead. And as the news cycle unfolds, you start to see a reflection of their positioning, right? This typically happens where oftentimes retail are left holding the hot coals, right? After investors have repositioned themselves in terms of risk. And I think that is what is going on currently with US oil. Now, if you look at my chart, you can see I have essentially 2 red boxes. I would explain the significance of these 2 red boxes and what I think about future oil prices. But before we go about explaining them, I wanted to explain the first question that came to my head when I wanted to go about my analysis of US oil. The first and personally what I think is the most important question, especially in these kind of circumstances, is what are the institutions doing right now? What is your sentiment? What is your expectations? Usually you can see a reflection. It would not necessarily need to show on your candlesticks, right? But we can actually study the behavior of institutions, in recent weeks to months leading up to this news cycle. Because again, you have to remember, institutions typically, they have access to, more experienced economists, right? Mathematicians and economic analysts that can analyze extensive research, gain all the information, and use, because again, remember, they're handling huge amounts of volume compared to you and I. So we simply don't have the same level of resources, access the same level of information to make long-term decisions, long-term investment decisions. So they do. So when we are in situations like this where potentially geopolitical events will impact the supply or the value of an asset like oil in this example, the main question for me is, can I see what the institution is doing? Is there a clear narrative being built in real time as the news cycle develops? And then that gives me clues, or that gives me insight as to what the institutions are doing. So what then led me to the answer, or what brought me to the conclusion or the answer to that question, was to take a look at the Commitment of Traders report to track commercial positioning, right? So if we go and take a look at the Commitment of Traders report, and what I am using here is a bar chart for my analysis. Now, when we are looking at the Commitment of Traders report, the main objective, of course, is to track what direction, essentially, the institutions have positioned themselves, right? Are they positioned on a net long basis, or are they positioned or on a net short basis, right? That is the main question. So a net short basis, of course, means they they're expecting lower prices, right? So because there is an oversupply of the commodity, and in net long basis is they're expecting. This is just a general summary of what it is. And the net long basis essentially is when the institutions are net long, right? Essentially, they anticipate future higher prices due to a decreased supply of that asset or an increased demand of the asset. So any fundamental factor that can increase the demand of an asset or decrease the supply of an asset leads to a net long basis by the institutions, because they anticipate future higher prices, right? That's how you get higher prices, essentially. Higher prices are as a result of either decrease in supply, which increases demand naturally, or increase in demand, which then decreases supply naturally, right? So that's how you get about higher prices. So now the main question here was, what are the most extremes within the last 2 years? That was the main question for me. So when you look at commitment of traders report, most people only like to look at commitment of traders report from the basis of, okay, are we above the net zero basis line, which means we're net long, which means we expect bullishness in the future months or weeks, or are we below the zero net basis line, which means we expect net shorts, or we expect a weakness in the coming weeks or months. And this is a much more simplistic layman approach to utilizing commitment of traders report. So what I like to look for in commitment of traders report is two main factors, right? So again, remember, commitment of traders report is tracking commercial positioning, right? So that is a definition, or that is what we're looking for. That essentially is a summary of what a commitment of traders report is utilized for, right? Now, if we're going to track commercial positioning, it is very important to understand the nature of these commercials. Now, unlike you and I, we have access to limited capital. These institutions, we're talking about multinationals, right? They have access to huge and deeper pockets of liquidity. So the way they position themselves is much more longer term, much more longer term that you can imagine, because they have access to deeper pockets of liquidity, right? When we view commitment of traders report, I like to view it from two bases. What is my long-term macro position? What are the institutional long-term macro position? I can get rid of this real quick because I think I just made an error there. And then number two, what I'm looking for is essentially quarterly hedge flows. So quarterly hedge flows essentially is when you have a longer term trend. A longer term trend usually is your weekly trend. That's what we call the macro trend. Within your weekly trend, you're going to get correction cycles, like cycles in which the market corrects multi-weeks. This is what you know as your quarterly hedge flows, right? Now, we are not really focused on quarterly hedge flows because we are in a situation where we have a massive geopolitical event brewing, right? And typically when there are massive geopolitical events like this, that causes a fundamental shift in near term to longer term supply and demand factors, right? So institutions will reposition as such. So if we go back and take a look at crude oil, the major question here for me is, what is the long-term macro positioning? How are the institutions positioning in the near future based off of their expectation with all of the geopolitical events, with Iran, the civil unrest, and the invasion of Venezuela, if you want to call it an invasion, all of those factors, right? Can we see something evident from institution positioning and use that to make a conclusion as to what their expectation is of this whole outcome? And of course, the safest trade will always be the trade aligned with institutional direction. Institutional directional pressure always offers the less or the least risky trade and the highest probability trade. Now, what you can see here, which is what I've delineated with essentially what was meant to be 4 vertical lines. So I'm just going to switch it back to make it 4 vertical lines here. And so what I've done here is this is the last 2 years range of crude oil. And we are using the weekly candlesticks, right? Now, what you can see here, my major question for tracking the longer term institutional positioning is, where are my extremes? Where were we the most extreme net long or the most extreme net short within the last 2 years is my major question, right? So if you go back and you take a look at where we're most extreme net long, you can see we have 3 major peaks of extreme net long. Now remember, when we are above the zero net basis line, this is the zero net basis line. That is net long. When we are below, that is net short. So if we start to trade above, that means that institutions are becoming increased in net long, meaning they're accumulating more long positions, or they're starting to offload short positions to then accumulate more long positions. Essentially, that is what it means, right? So this is that net zero basis line here. And again, typically retail, how retail utilizes the concept: above net long, below net short. Now, what I am looking for, like I mentioned before, is the extremities. Where were we the most extreme within my defined range, in this case, 2 years? Here, now we had 3 peaks, like I mentioned before. This is peak number 1, peak number 2, and then the most recent one, which is peak number 3, right? I have really cool points coming up with all of these information. Now, again, I don't necessarily need to take a look back at peak number 1 because I can already infer from this what it means, right? So you can see here, as we went into the month of October, we were starting to go a lot more extreme net long. Now, typically what you expect is, as we trade up above that net zero basis line into extreme net long, once we start to trade away from there, you want to see the distribution of that net long. So as we start to trade lower from extreme net long, you essentially want to see the market go up, right? Because again, if commercials are building net long and then the market starts to trade away from net long, that means that they're starting to offset some positions. That essentially is what it means, right? Now, you can see here, as we start to trade lower, you would expect the market to go up, and it did. The market did go up, reflecting that those institutional accumulation down here. But now the next question, of course, is, but we just literally saw the market go lower. The price literally went down after what you are seeing right now, Gene. You're seeing that institutions bought inside of this range because we were extremely long here. Well, sure, we did see some bullishness, maybe 1, 2, 3, 4 weeks of bullishness, but you can see the market still went lower after that. Now, this is where you have to understand the nature of institutional positioning versus the retail, how we engage with trades. Institutions are more long-term focused. So it typically takes them multi-months to a lot of times years to build in a long-term position. Unlike retail, where we're essentially executing on an M15 chart, institutions are not approaching investing the way we approach investing. They need years, months to years to actually build a position. So what you're seeing here, this is my interpretation of market data, and of course, over the next coming weeks to months, right, that would reveal, the validity of my analysis. But what you can see here is inside of this range, we were extremely long here. Market rallies away from there, reflecting that there was a level of, institutional accumulation inside of this range. And then we run lower again. Now, remember, institutions would not buy when the market is going up. They accumulate when the market is going down because they make the market, right? They initiate order flow, not you or I, right? So now what I do have here is at least essentially 3 bearish candles preceding the small little correction in price here, right? This was the second time we're the most extreme net long in the last 2 years. And you can see a bit of bullishness after that. And then we slam hard. Boom, we slam down lower, right? And then you can see the market goes back and forth until the most recent one was these two down candles here. That was the most recent net long basis. And you can see one more candle indicating that there was a measure of, institutional buying going on. Typically when we see down candles like this and the market starts to trade away from there, we want to see some level of bullishness. But now in this situation, this is a little bit different. Now you can see in the previous example, as the market starts to trade away from there, it does not trade away from the net long basis sustained. It does not trade down away from there, right? So we can go back and look at previous examples in which the market was more longer term bullish, and you can see when price, you can see in this example here, this was the most net long. This is from 2023, right? So I wanted to use an actual example to kind of explain what I mean. So you can see 2023, we were extreme net long here, and we traded significantly, not just a little bit away and then back into extreme net long basis. No, we traded significantly away from there. That means that we are starting to distribute net long, which then leads to a sustained bullish trend, which you can see here. We had a bullish trend over a few months, right? If you compare this to what we're dealing with currently, right, with the most recent price action, to this, you can see this run lower is not sustained. It's just a little bit. So all of this information here is we're seeing extreme net long accumulation going on until this most recent price action. Now, this is what is weird here, right? What would expect if you look at this run lower on oil, if you compare that to, as in the previous example like I gave you before, where we went from an extreme net long basis and we started to trade lower, where you would expect a bullish trend, you can see here, we rather than getting a bullish trend, we actually had bearishness in the marketplace. That's so weird. That is weird. Institutions were extremely net long. They accumulated net long positions, right? But then as we start to trade away from net long, we expect to see the distribution of those institutional or commercial net long, but instead we see lower prices. What is going on in there? Now, that takes me to the next point of the video, which is understanding market profiles. Again, this is where we combine fundamental analysis with technical analysis, right? Now, the reason why you did not get the bullishness when we saw this most recent extreme net long and the market started to distribute away from there was because we were inside of a consolidation. In consolidations, a lot of time, institutional positioning would not reflect. And the reason why institutional positioning would not reflect a lot of times is because there is extreme manipulation going on. Again, remember, when there is manipulation, that's when you tend to get asymmetry in price action, meaning supposedly correlated assets, they will start to move asymmetrical. Now, anything you can take away from this video, and I know this is starting to get long, and in my last YouTube video, someone complained about the fact that my video was way too long, and this is currently almost half an hour, and I will wrap this up so quickly. But the one thing I want you to take away from this is symmetry in the marketplace is a function of order flow. When liquidity pours into an asset, that would reflect with a correlated, not of the same magnitude, of course, but a correlated sponsorship on correlated asset classes, which is why typically when dollar is trending, you tend to see both euro US dollar trend and pound US dollar trend and Aussie US dollar trend typically. And when dollar is consolidating, this is where you start to see asymmetry between euro, where for example euro could be bullish and cable could be bearish and Aussie could be bullish and US CAD could also be bullish, and you're just looking at the market and you're like it doesn't make any sense. Yes, it does not make any sense because there is manipulation going on. Assets are being held, manipulation is going on. There is no current institution sponsorship. So when you have a situation in which there is manipulation going on, a lot of times institutional position might be muddied. The information as regards to institutional position might be muddied. So when you're applying commitment of traders report, right, you have to apply that in the context of a consolidated market. Now, here is the theory. Here is the expectation. This is why I told you that the red boxes will make a lot of sense. So if we match these lines here, again, I'm not going back to the consolidation because we know in this consolidation there was institutional accumulation going on in there. But if we match the vertical lines where we saw the most extreme net long on the Commodities traders report on oil, and we match that with US oil here, you can see that would reflect that institutions were accumulating net long inside of this consolidation, and then in these 3 down candles, and then in these 2 down candles. But now the reason why, despite the fact that we're seeing a distribution away from that net long basis, naturally we would expect higher market prices, but we're not seeing higher market prices. The reason for that is because we had a consolidation. The high post, the second buy, right? This is the second net long basis. First one, second one, most recent one, which is the third one, right? So post the second net institutional buying of oil, we saw the market actually drop lower and creates a range. It creates a consolidation profile. We trade above the high of the consolidation profile, and what do? Trade back inside the range. Now, study the nature of the run lower. You can see the run lower. It is not one-sided. It is so slow, has a lot of consolidation. So you can see consolidation and then 2 down candles and a lot of consolidation, and then 2 down candles and a lot of consolidation. Is this indicative of a market that is being sponsored lower, or is this indicative of a market that's being engineered to collect sell-side liquidity before it starts to run higher? Now, this is how all of that ties back into my analysis. So you can see already from our Commodities traders report, right, that institutions are net long. So of course we know that institutions are expecting higher oil prices in the future. Now, how does that tie in with our technical analysis? If we take a look at price from a technical standpoint, you can see here we have a massive weekly inefficiency. We have a massive weekly fair value gap in here. Now, I can actually go out to a monthly time frame, and then the narrative becomes even a lot more clearer on a monthly time frame. If you go take a look at price on a monthly time frame perspective, you can see here, this was that oil shock 2020. Remember the oil shock 2020 when the all literally almost went to zero? If you look at that run lower, we had a major low from 16th of February. We ran below that. The last 2 up bullish candles prior to the run lower, right? That's where we're sitting in right now. So we have a break block, pre-zero evaluation for oil, inside the monthly fair value gap. If you go out to the monthly time frame, you can see even clearer that this is a consolidation. All of the subsequent price action after that second time the institutions bought, you can say that huge 1 monthly candle, every subsequent monthly candle since the 1st of April has been inside of this down candle. Verifying that, of course, is the consolidation profile. So my expectation is, I do believe that Trump will get involved in Iran. And when he does get involved in Iran, there will be a lot of opposition from people within the US. There will be a lot of factors that would affect, with like potentially other countries being involved. And I think investors, they've already priced all of this in. And that is why I expect that there should be higher oil prices. I do expect in the upcoming months. I think before the end of the month, Trump most likely gets involved in Iran. And all of a sudden, you start to see oil scream higher. And if oil screams higher, you know why. I already explained in almost a half-hour video Why? All we did was just track institutional positioning. They have a lot more information that we do, and we're leveraging that information. Now, what I'm looking for, what I do like in terms of a technical standpoint on oil. So if I switch over to the daily time frame, right? And I use a 1 year range for the daily time frame profile. Now, I want to draw attention to this, right? So if you see between, let's look at what date this was. This is the 2nd, I think. Yeah, this is the 2nd of May, 2025. So between the 2nd of May, 2025 to 5th of May, 2025, we had a market gap there. So this candle closes here, and then we opened down here. That is a market gap, right? So what I believe is that future higher prices were being deferred to allow the market drop lower, fill in all of the gap, and collect sales liquidity down here. And I do think that we're starting to see a flip. Now, what I'm looking for, of course, which we will start to track. Again, this is a lot more in-depth analysis. Subsequent analysis is not going to be as in-depth because I've already covered this on a video like this. So what we're going to track, of course, is the confirmation of our thesis, right? So there is a potential because we're referencing this low. Again, remember, a consolidation is just like here and this low. These are consolidations. So you can see we traded down below the low of our of the daily range low of our consolidation. I'm starting to stammer. That's so bad. The daily range low of our consolidation, which essentially traded down below there. We've not yet seen a breaking structure. So a breaking structure will be a break above the side here, which is what I'm looking for. If we do get a breaking structure on this, then I think I will be massively short Canadian dollar, right? So a lot of beautiful trades we can leverage on the Canadian dollar. For those of you guys that trade oil, once we break structure above like this, I will start to cover oil as a part of our weekly analysis. And I will, when I talk about oil, I deal more on swing trades, right? So we can actually spot trade oil as a swing trade, just like we do on gold. And so in the upcoming weeks to months, not necessarily even months, in the upcoming days to weeks, once we get a confirmation I'm looking for, again, I will track this literally every single day. Then I will start to give you longer term levels as regards oil and other derivatives or other assets that moves in tandem with oil, like Canadian dollar, for example. So US CAD will be a big one, and we would have really good trades in US CAD. So I think it should be wonderful. Again, let's see what happens from here, but I do expect high oil prices. Now, what I am looking for is I want to see the market. We have two down candles here. I want to see a rally. Most ideal, I want to see a rally from here that then breaks structure, and that break of structure is then feedback for me to go in and start to aggressively trade higher oil prices. Now, if we don't get that run and break above this high here, then I would expect maybe one more sweep, which I don't currently think so, but that would indicate that we want to maybe collect one more sweep of sales liquidity. And then also from there, I will still start to hunt, bullish setups. So essentially the conclusion from this is if we get one more sweep of sales liquidity, then I will start to focus a lot more on oil and Canadian dollar pairs, looking to trade them long aggressively. If we get a response, which is what I think currently, if we get that response from here that then breaks above, this bullish order block, that to me is a breaking structure, and I will start to buy every retracement until we run back up above the side here and the side here. But I do think in the upcoming weeks to months, we should see around $80 a barrel. And I think it could be really, really one-sided. So that will be all for now. I will see you in the next video where we do a lot more commentary on, other asset classes. And hopefully you enjoyed this and you also gained some insights from this. And I'll see you on the next one. Trade safe.